Welcome to another edition of Hours and Minutes, where we take hours of information and condense it into just a few palatable minutes. With me again, we have Michael Tessler, BUI's president. And Michael, speaking of hours and minutes, how many hours and minutes has it been since you got a haircut?
I think we stopped measuring that in hours and minutes a long time ago, and we're definitely on to weeks and months. But
Well, we're going to start getting concerned when it starts hitting your shoulders. All right, the question we received this week is related to premium financing for life insurance. Obviously different than premium financing for property and casualty insurance. And I'm glad we got the question because we get quite a few inquiries about this subject. Could you take a minute or two and explain exactly what it is?
Just like the name says, you're financing a premium as opposed to paying that premium out of your own cash assets. So take a business owner who figures for every dollar that gets invested in the business, there might be, say, a 15% return on that dollar, versus getting a loan to make that premium payment at, say, 3, 4, 5% in today's market. That's a pretty big arbitrage. And that person, even though they could pay the premium, they're saying, you know what, it makes more sense for me to finance that premium for now. And if and when that arbitrage changes, I won't. But for now, it makes more sense to pay that premium with finance dollars than my own dollars.
So it's an affluent individual who could pay the premium, but they're getting greater leverage somewhere else, essentially.
Correct. In some instances, it may also be somebody who has very illiquid assets. Take somebody who's got a huge estate that's mostly real estate or farmland or something like that, where they may not have as much cash on hand as you might expect for the size of their holdings. So they may choose to finance that premium so that they're not cash strapped, even though they have very large, significant assets.
So that would be sort of an ideal scenario where when they pay back the loan, it's when they're feeling less of an arbitrage there.
Exactly. If loan interest rates start to climb, if return on their investable dollars starts to decline, either way, when that arbitrage starts to shrink, that's usually when they start looking at options for repaying that loan.
So premium financing sometimes has a rather negative stigma in certain scenarios. What scenario would give you pause or draw your concerns when you see it?
It has recently become popular to finance a premium for a life insurance policy with the idea that usually an indexed universal life insurance policy, that the policy is going to perform in incredible ways and have so much cash in it that shortly after you've bought it, within the first decade, you're going to be able to pull all that cash out, repay your loan, and still have so much cash in the policy that it's going to self-perpetuate. And unfortunately, you're very different than the first scenario we talked about. You're now relying on a life insurance policy to do unbelievable things in an effort to repay that loan and make this a good deal for the person that goes into it.
So when you're talking about essentially the illustration manipulation, you're talking about high hypothetical interest rates needed on the sales illustration to show projections that are strong enough to be able to actually withdraw cash, repay the loan, and not have the policy lapse.
That's exactly correct. And unfortunately, those overzealous projections frequently do not occur. And I will tell you, we get an advisor coming into BUI almost weekly with somebody who went into one of these strategies. It's not going well. They're looking for ways to get out of it. And much like a marriage, it's white and flowers and pretty on the way in, not very pretty on the way out.
Well, yeah, and we're posting almost daily on our news feed the constant decreases to caps and interest rates on these products. So it kind of highlights the need for somebody who is using this strategy to make sure they review the policy to make sure it's meeting expectations. But when you look at this, you've got a lot of parties involved. You've got the insurance agent, you got the insurance company, you've got the bank or other financier, and then you've got the lendee or the client. So if this doesn't perform up to expectations and everybody's sort of in this together, is this a joint? Is everybody jointly taking this on the chin? or is it just the client left holding the bag?
Yeah, it unfortunately is the latter. An insurance agent who sells one of these policies gets paid most of his commission in the first year. He walks away from this thing happy as a lark. The insurance company has underwritten somebody. They've got a large life insurance policy that they've properly underwritten. They're happy with the transaction. You've got a lender with a well-heeled, wealthy client, plenty of collateral, making a loan to them. They're not, there's no way they're in any kind of trouble. The only person that's in trouble here is the person that bought this thing. I might also point out, you mentioned the low interest rate environment that we're in and that we're watching caps and interest rates and things going down. It's an interesting phenomenon here because, of course, for the bank loan, this low interest rate environment is really attractive. But for the life insurance policy, this low interest rate environment is a real problem. And unfortunately, it's that life insurance policy not performing that is going to cause the person that entered into this transaction to have some real problems on their hands.
So to summarize, premium financing can make a ton of sense for a very well-heeled client who wants to leave their cash deployed for other reasons, for leverage. But for those who can't pay the premium because without the loan, and who plan to use the cash value from the policy to repay the entire loan, are those that should essentially have some concern.
Indeed. And even if they could pay that premium, if they're counting on a life insurance policy to perform at a ridiculous level, there is probably disappointment in their future.
And last question, you mentioned large premium as it relates to when this could make sense. I think a lot of people have a different definition of what a large premium is. At what level of premium does premium financing, or should premium financing really start to become a part of the discussion?
I would say it normally gets considered when the policy premium is in the neighborhood of six figures or multiple six figures. It's at that point that somebody says, look, that's enough money that I could deploy that elsewhere and make a much more substantial return, making the loan interest look small because of redeploying the money someplace else. Much smaller than that, it may not make as much sense.
Got it. And for those who may have watched Hours and Minutes last week, premium financing being different than private financing, as you'll see. So, Michael, thank you again for your participation today. If anyone has any questions about premium financing, Michael's the guy to talk to. If you have other questions that you'd like to see addressed on Hours and Minutes, please email marketing@buiusa.com.